Hello and welcome to the session. Financial Reporting LO3. Prepare financial statements for an incorporated organization to meet legal requirements and business objectives. Why are financial statements crucial for incorporated organizations? These statements ensure legal compliance and support business objectives like performance evaluation. Discover how financial reporting obligations differ between incorporated and unincorporated organizations. Incorporated organizations are separate legal entities from their owners. They must prepare formal financial statements, including statements of financial position and profit or loss. Unincorporated organizations like sole traders have simpler reporting needs. Their financial reports are mainly for tax and internal purposes. This distinction affects how financial statements are structured. Incorporated organizations follow strict formats for financial statements. These formats ensure consistency, transparency, and comparability. Unincorporated organizations have more flexibility in presentation. This reflects the higher public accountability of incorporated entities. Limited companies, in particular, must adhere to these regulations. Incorporated companies can be limited by shares or guarantee. Companies limited by shares are profit-oriented, while those by guarantee are often not-for-profit. Private companies face fewer disclosure requirements than public companies. Public companies have stricter reporting obligations due to public investment. These distinctions affect financial reporting. Financial reporting for incorporated organizations uses specific terms. Share capital, retained earnings, and distributable profits are key concepts. Legislative developments like company law reforms shape reporting standards. The adoption of IFRS aims to improve transparency and investor protection. These changes increase financial reporting complexity. Financial statements allow for performance comparison over time. Stakeholders assess profitability, liquidity, and efficiency. However, financial statements have limitations. They are historical and may not reflect current market conditions. Non-financial factors like brand value are not captured in these reports. Limited companies must prepare income statements and statements of financial position. These statements meet legal requirements and support organizational objectives. Compliance with company law and accounting standards is crucial. Directors are responsible for statement accuracy. Financial statements are filed with regulatory authorities. Limited companies must adhere to company law and accounting standards. They must present a true and fair view of financial performance. Many companies are subject to audit requirements. Financial statements must be available to stakeholders. Meeting these requirements ensures legal compliance. Capitalization is crucial in financial reporting for limited companies. Share capital represents equity finance from shareholders. Loan capital, like bank loans, is recorded as a liability. Understanding equity versus loan capital is essential. Equity does not require repayment, unlike loan capital. Limited companies distinguish between authorized and issued share capital. Authorized share capital is the maximum allowed to issue. Issued share capital reflects actual shares distributed. Shares are recorded at nominal value. Market value is not recognized in financial statements. Debentures are long-term loan capital treated as non-current liabilities. Interest on debentures is a finance cost in the income statement. Reserves represent accumulated profits or specific allocations. They support dividend policy and financial stability. Reserves are accounting entries, not cash balances. Financial statements must comply with IFRS for consistency. They use standardized terminology and layouts. Correct asset and liability classification is crucial. From a business perspective, these statements support decision-making. They demonstrate financial stability to investors and lenders. Both incorporated and unincorporated organizations prepare financial statements. The structure and purpose differ due to legal status. Incorporated organizations follow company law and accounting standards. Unincorporated organizations have simpler, more flexible statements. These differences highlight the influence of organizational form. Both types of organizations measure profitability and financial position. They produce income statements and statements of financial position. Financial statements support decision-making and tax obligations. Despite differences, the purpose of reporting is shared. It is to assess performance and meet obligations. Incorporated organizations have prescribed formats for statements. Unincorporated organizations have more flexibility in layout. Higher public accountability affects incorporated organizations' reporting. Unincorporated organizations face fewer statutory requirements. These differences reflect legal and regulatory influences. Incorporated organizations use terms like share capital and dividends. Unincorporated organizations use capital accounts and drawings. These terms reflect ownership structure and profit distribution. Profits in incorporated organizations are retained or distributed as dividends. Unincorporated organizations allocate profits directly to owners. Incorporated organizations distinguish between equity and loan capital. Share capital is recorded separately from liabilities. Unincorporated organizations rely on owner capital and borrowings. This affects how financial risk is presented. Capital structure influences financial statements presentation. Year-end adjustments ensure correct income and expense recognition. Clear capital structure presentation aids stakeholder understanding. Financial statements must reflect economic reality. Adjustments improve accuracy and compliance. They link financial preparation with structure and decision usefulness. The statement of profit or loss reports revenue, costs, and profit. It includes adjustments like depreciation and finance costs. This ensures expenses are recognized accurately. The statement supports assessment of profitability and cost control. It reflects actual performance for the year. The statement of financial position shows assets, liabilities, and equity. It distinguishes between current and non-current items. Equity is shown at nominal value, with share premiums separately. Debentures are classified as non-current liabilities. The statement reflects financial stability and risk. In conclusion, preparing financial statements for an incorporated organization is essential to meet both legal requirements and business objectives. Accurate and well-structured financial statements ensure compliance with accounting standards and statutory regulations, while also providing valuable insights into the organization's financial performance and position. These statements support informed decision-making, performance evaluation, and strategic planning. Preparing compliant and reliable financial statements demonstrates good financial management and enhances stakeholder confidence in the organization. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 0748 436 1688.